Okay. So my name is Eugenia Yudanin. I'm chair of the Professional Advisor Network of the Jewish Community Foundation. Thank you so much for joining us today for this webinar called Leaning into Social Distancing, a perfect storm for wealth transfer, featuring Thomas Pawlowski of Bernstein. The reason for today's webinar is that as advisors, we should keep up to date and stay current on the most recent developments, economic as well as legal. And Tom is going to help us with that. If any one of you read the recent Green Book from the Treasury, you will know that we will need all the guidance we can get on the proposed changes. Also, as another aspect of this, many of us have charitably inclined clients. And therefore, I wanted to remind you that the Jewish Community Foundation houses many donor-advised funds and endowment funds, which provide donors with a lot of flexibility in making their charitable bequests or donations and otherwise meeting their philanthropic objectives. So with that, I want to pass the stage to Ben Lorhoff, who is on our Professional Advisor Network Committee and is also a board member of the Federation.
Thank you very much, Jenny, and thank you all for joining us today with the Jewish Community Foundation. Before we launch into Tom's presentation, I just want to talk a little bit about the work that we are doing at the JCF and what we've accomplished. Our organization was built to respond to the urgent needs of the community, and COVID-19 clearly provided an opportunity for us to help. If we look just sort of what we've done as a community, over $9.2 million of grants have been made by the JCF and our Federation fund holders to help out during this pandemic, which is a pretty proud number, and I think many people on this call, right, have helped in that, and a sort of a silent round of applause or pat on the back needs to be given. As a reminder, the perks of working with JCF for your donor advised funds is that you're invited to learn about local and global needs, right? Find out where people need help. You're invited to philanthropic programming. You can consult with JCF's Center for Strategic Philanthropy to help with your philanthropic needs or those needs of your clients. And many just great additional services that are provided through our JCF. So if you don't know JCF, I would encourage you to reach out to the team and sort of get to know them better. I'll take this slide down, but just again, a little pat on the back for the work that's been done. All right, so now we get into the fun. So it's my pleasure to introduce my colleague, Tom Pawlowski. Tom is a managing director in our wealth planning and analysis group. Tom is a lawyer by training, but has tipped over into being an analyst at Bernstein for longer than he was a lawyer. Tom helps us with all the complex issues that our clients are dealing with, and really trying to help understand the numbers and what the future looks like for all of the planning ideas that you as professionals may be recommending to your clients. Particularly helpful in an environment like today, where there's a lot of complexity and there's a lot of what might happen, what might not happen, to be able to help clients pre-experience the impact of a decision that they're going to make, and what might be the right path of planning for them. Tom's bio went out earlier. It's long, it's impressive. He's a wonderful guy, but I won't. His time is better used teaching us than running through his accolades. Tom does like an open format, so to the extent that you do have questions today during the presentation, just feel free to put them in the chat. Use your hand raising feature. We'll be monitoring those. If you struggle with Zoom, but you really have a question and you can't figure out how to get in the chat, just call it out. We want to make sure that everybody kind of gets covered today. And then in the event that we don't get to all of the questions or you didn't hear yours answered, just feel free to either email myself or Yafa directly, and we'll make sure to follow up. So without further ado, Tom, I will turn it over to you.
I like to do, as you know, Ben, but if we don't want any further, that's okay with me, I guess. I have to tell you that I brought a presentation with me, but there's a decent probability that we might not get to it, just because the last, say, half dozen or so discussions like this I've had, there's so much going on and things are moving so fast that sometimes it's just all about the Q&A and we don't actually get into any of the case studies or things that I brought along with me. And that's absolutely okay with me. I just want to make sure you know that this is really about making sure that you get what you need out of this event and not for me to have some agenda that I'm pushing out onto you. So it's really been a dramatic year and I want to get right down to business. I will break several times to take questions. But if you have a question and you want to sort of get in the queue, by all means, as Ben said, go ahead and do that. That'll be just fine. If we don't get to any questions afterwards, you can forward questions to Ben if you have his email. You can forward questions to Yafa. Each of them will make sure that I get them and I will answer them same day. I did an event this morning. I got a bunch of questions from that. All those questions were answered and I expect to do the same thing this afternoon with any questions that we don't get to here. So I don't know why 10 days ago, a monumental event occurred and it's gotten virtually no press coverage, but I'm going to give you that coverage right now. 10 days ago, the day before the Memorial Day holiday, Elizabeth McDonough, who's the Senate parliamentarian, gave further guidance on what would be required for a bill that would be passed under the reconciliation process this year. Some of you may recall that on April 5th, Ms. McDonough ruled that the Senate could have more reconciliation legislation this fiscal year, meaning that that legislation could be passed with 50 votes in the Senate, presumably the 48 Democrats and 2 independents, including Bernie Sanders, would vote in favor of that legislation. And then the vice president would consent, and that would be enough to get the legislation through the Senate. And if it passed the House, would land on President Biden's desk and presumably be signed. That the Democrats could use that procedure multiple times this fiscal year. But on April 5th, she did not elaborate on how exactly that would work. Well, on March 28th, she did elaborate and it basically dropped a procedural bombshell on the Democrats because she said, oh yeah, you can do more reconciliation bills this fiscal year, but you need Republican cooperation to do it. And that shocked a lot of people, just like the April 5th ruling shocked a lot of people that you could do multiple rounds of reconciliation. This one did too. Here's what the parliamentarian said. She said, if you want to advance a piece of legislation to the Senate floor and have it passed with 50 votes and the approval of the vice president, you have to get through the Senate Budget Committee. The Senate Budget Committee has 11 Democrats and 11 Republicans. And ordinarily, if they vote on a bill and it's tied 11-11, it goes to the floor. But there's a problem. A quorum of that committee is a majority of its members, not 11, 12. And if the Republicans don't want to grant a quorum, they simply don't have to show up. And you can't represent the Republicans by proxy under the Budget Committee's rules. So the effect of the Senate parliamentarian ruling is that if you can't get something together to which at least one Republican somewhere agrees to, you can't do anything with the reconciliation process until the fall. And that is a big deal because just days before that, President Biden had released some details about his proposal. And one of those proposals was that for taxpayers with $1 million or more of income, that their capital gain tax rate would be in effect doubled to 39.6%, and that provision would become effective on April 25th, which was the date of President Biden's address to the joint session of Congress when he announced many of these legislative initiatives. Well, that's great if you've got a bill that's going on the fast track and you're going to be able to pass it in June or July. But what's the implication if you can't even get that bill introduced until the fall? Would there still be a retroactive tax increase like that one? And would it be made retroactive to April 21st or perhaps all the way to January 1st of the year? Now, there's some precedent. Back in 1993, you may remember that there was a Democrat in the White House. There were solid majorities of Democrats in both the Senate and in the House. Tax legislation was proposed. It took a while to get all the provisions worked out, but ultimately both houses of Congress passed that legislation. It landed on President Clinton's desk. He signed it on August 10th, 1993. I remember that day well. It was my birthday. I was 17. And they made that legislation retroactive to the first of the year. So it's possible to do this during the summer and have that done. It's been done before, been there, done that. It's also constitutional to do this in the fall, to say we're passing legislation, it's November 10th or December 10th or whatever it is, and we're making it, certain aspects of it, retroactive to January 1st. But politically, is that acceptable? Will there be enough moderates who will go along with that? Because the moderates have expressed some reservations about several different things that might be included in these packages. And there may be, if it only takes one moderate, it only takes Joe Manchin in the Senate, the Democrat from West Virginia, to say, not doing that, and it's kind of done. You know, if he digs his heels in and says, I'm not voting for that. And a lot of them have expressed some reservations about the fairness or lack of fairness in retroactive legislation, especially now, not a bill that would be passed, say, in June or July, but a bill that might not be passed till November or December. So there's just a constant twist and turn to what's been going on in Congress. First, we had early in the year, we didn't know whether the 2 seats in Georgia were going to go to the Democrats or to the Republicans. Well, both of those seats went to the Democrats, and everybody quickly learned that it's possible to pass legislation with 50 votes in the Senate and the consent of the vice president. We got that. And then we had further education of ourselves that, well, once the coronavirus relief package passed using the reconciliation procedure, that was it. You could only do one bill like that each fiscal year. Any additional initiatives would wait until the fall. And that gave those of us who do estate planning some time to ponder and think about what we might want to do with our clients. But then the parliamentarian ruled that, no, you could do multiple rounds of reconciliation, ruled that on April 5th. And we said, we better get back to our clients and let them know that some of this stuff might get accelerated and some of it might be retroactive to the first of the year. And now the parliamentarian ruled 10 days ago, that you can use multiple rounds of reconciliation, but not without effectively Republican consent. So we've had to zig and zag and zig and zag, and who knows what the next development will be. More on that in just a moment, but let me just check in with the group and see if anybody wants to ask any questions or make any clarifying comments about anything that I've said so far about recent developments. Anybody at all? I'll check the chat page while you're thinking about that. Nothing? Okay. All right, so where does that leave us? Well, now we've got 2 legislative proposals, essentially, that President Biden has laid out for the country. One would be, I'd loosely categorize as infrastructure and transportation. And that proposal had one tax piece attached to it. And it was the president's proposal to increase the corporate income tax rate from 21 to 28%. You may recall that the corporate income tax rate in the United States through 2017 was 35%. The Tax Cuts and Jobs Act lowered that all the way back to 21%, and President Biden had proposed to bring it halfway back to 28%. Immediately, some of the moderates in Congress said they couldn't get on board with a 28% rate. They might be able to get to a 25% rate, and the president agreed to that. But now the proposal seems to be, from the president at least, let's keep the corporate tax rate at 21%, but there would be a minimum tax rate on any US taxable corporation of 15%. In other words, corporations couldn't go and wipe out all of their corporate income and not pay any tax. And we'll see whether that proposal gets through. Presumably then, if somehow that makes its way through Congress, then there wouldn't need to be any more tax proposals with the infrastructure and transportation plan, that it would, whatever was going to be paid for was going to be paid for by that tax on corporations, not an estate or gift tax and not an income tax. Will that get through? We'll have to see. Now, with the parliamentarians ruling, at least some of the Democrats have said, well, if we're going to have to jam everything through in the fourth quarter, we're literally going to jam everything through. We're going to package it all up in a massive bill. We're going to put it through in the fourth quarter, and all the initiatives and all the tax proposals will be wrapped up in that single bill. that is viewed by many people as politically unstable at best, that the price tag on that would leave a bad impression on the American public. And when the midterm elections came around next year in the fall, that the Democrats would get stung by that packet, that their opponents would be pounding the table and saying, remember that $5 trillion package that got passed in the fall? That was all those guys, and all they want to do is spend. And some people are worried that that would be politically suicidal. So another approach would be, if the Democrats could break off some of that infrastructure stuff, get enough support from Republicans to get it at least through the Senate with 60 rather than 50 votes, they wouldn't have to use the reconciliation procedure, and at least they could get a piece of that settled this summer, saving all the rest for later in the year. That may have roadblocks within their own party, perhaps from the progressive wing of the Democratic Party. There's another possibility that the Democrats could use. They could change the rules in the Senate. They could repeal the so-called Byrd rule and say, you know what, anything that goes through the Senate requires a simple majority, or as things stand right now, 50 votes plus the concurrence of the vice president. And we're going to get rid of all this 60 vote stuff. That would be playing with political fire, because there are a lot of people that would view that as overreaching. I think a lot of the Democratic senators would be afraid of that, because sure, it's useful now, but what's the situation going to be like 3 years or 5 years or 7 or 10 years from now? The political tide may have turned, and now you've got your enemies able to get things through the Senate with just 51 votes. And that may be viewed as something that people don't want to do. So lots of questions about how all that's going to play out. How does that affect the taxes that have most impacts on our clients? The gift and estate tax and its cousin, the generation skipping transfer tax, the GST tax, and the income taxes. How is this likely to play out? Well, let's start with the easy part, which is the transfer taxes. There is no serious proposal on the table right now that would change materially any of the estate or gift tax laws this year. There is a proposal from Bernie Sanders for the 99.5% Act that would change some of those rules. In fact, seriously change those rules effective as of January 1st of next year. But those are not proposals that have been adopted by the administration. Not that they need to adopt them. Congress can do whatever it wants with legislation. The president's authority is limited to the ability to veto legislation. But as things stand right now, there does not appear to be a strong appetite in Congress to change the estate and gift tax rules per se, and certainly no appetite to do that this year. Now, I don't know about your practice, but mine, most of the meetings that I was doing up until a few weeks ago were people who wanted to make a gift that would use up all or whatever was left of their $11.7 million exclusion for gift and estate tax purposes, and whether that was safe, whether they could do that and then it would backfire on them because Congress could retroactively reduce the amount of the exclusion, say all the way back to $3.5 million, maybe all the way back even to $1 million for gifts made during life. Senator Sanders' bill says, let's go back to the year 2009, where the exclusion amount was $3.5 million, but you could only use $1 million of that during your lifetime. What if that got enacted in one of these bills and was made retroactive to January 1st? And I've made an $11.7 million gift. Is that going to cause me to have to pay a gift tax that I didn't anticipate? I was doing a meeting with someone. I don't remember the exact circumstances, and I don't remember whether she called me Sonny or Buster. I think she said Buster. She said, listen, Buster, I'm not paying any gift tax. And I said, got it. You're not going to pay any gift tax. What do you do in a case like that? And there are actually 4 strategies that a client could use that if they just come in and said, not paying it, got it, not paying it, that you could make a gift retroactivity proof. And so what are those methods? Well, if you had a client that was making an $11.7 million gift, what if you wrote that gift up and put it in a formula that said the amount of the gift is equal to whatever the exclusion amount is as of the date of the gift. Whatever exclusion would apply to that gift, any excess will go to something that isn't gift taxable, a marital trust, a zeroed out CLAT, a zeroed out GRAT, or something else that wouldn't generate any current gift tax. Would that work? Well, the only example we have are the defined value clauses that are described in the cases Wandry versus Commissioner and its progeny. And this is a different kind of formula. In the Wandry cases, we say a formula based upon values as finally determined for federal gift tax purposes. This is not based on a lack of understanding about the value of the gift. It's based on a lack of understanding of the exclusion amount itself. And where do you see clauses like this? Every day. In testamentary documents, in wills and revocable trusts. That is the formula that's used in just about every one of those documents. It says, take whatever exclusion I have left at my death and put that in a credit shelter trust, and take whatever's left if I'm still married and put that into a Q-tip, let's say marital trust, or maybe into a charitable bequest to the Federation, or some combination of those two things. We know that formula works at death. Why shouldn't it work during life? And the reason why it might not work during life is that the donor might have some hook on that formula that would allow them to do something that they are not otherwise allowed to do for gift or estate tax purposes, something that would make the gift incomplete, or something that would cause the gift to be includable in their estate under, say, Section 2036 or 2038. And so I absolutely believe that that type of a formula clause, not a Wandry clause, but one that we typically use in testamentary documents, can and should work. And that would be one method that we could use to make our clients' big gifts retroactivity proof, if anybody's still concerned about a retroactive application to a reduction in the exclusion amount. But that's not the only arrow that we've got in our quiver. What if I were to say, make a gift to Ben and say, hey, Ben, I'm making a gift of $11.7 million to you. But if if the law goes in the wrong direction, don't use any of this money for the next 9 months. And if the law goes in the wrong direction, I need you to disclaim and have that gift come back to me. And Ben, being the nice guy that he is, says, oh yeah, no problem. I'll be happy to disclaim that, Pops, because I don't want you to have to pay, any gift tax in order to make that gift. I'll disclaim all but, let's say, $1 million of it, if that's how the law turns out, and the rest of it will come back to you. Well, I'm not a huge fan of this disclaimer type approach. And most of the approaches have said, let's use a gift in trust rather than an outright gift. There are a whole host of issues you have to think about when you want to use a disclaimer, not the least of which that not every human being on this earth is as principled as Ben. They may say, oh, sure, Dad, I'm going to disclaim if things don't go right, and then say, oops, just kidding. I like having $11.7 million. It suits me quite well. And or the mistake gets made that the people actually use the gift, in which case it doesn't qualify as a disclaimer under Section 2518 anymore. Did you know that each state has its own disclaimer rules? And so the disclaimer that you do has to follow not only federal law, the tax laws, but also state laws of disclaimer, which can differ from the federal laws in certain cases. What about this? What if I make a gift in trust and Ben is the trustee of that trust, and there are a whole host of beneficiaries? The law takes a left turn. Ben, in accordance with a handshake agreement with the grantor, says, I'm disclaiming all but $1 million or 3.5 or whatever the magic number is of this gift. Everything else is going to revert to the grantor. How is Ben fulfilling his obligation to the beneficiaries of that trust by making a disclaimer of that gift? Who's benefiting from that disclaimer? It's me, the grantor. Ben's absolute duty of loyalty goes only to the beneficiaries of the trust. It doesn't go to me. So I think structurally, those disclaimer trusts can be tricky to do. I think the best suggestion that I've ever heard, and I heard this at Heckerling, among other places within the last few months, is to say, if you're going to do this in trust, make it a trust that's fully vested in, let's say, Ben, if he's the trustee and beneficiary. If Ben disclaims, the assets go to an entirely separate trust for the benefit of my descendants, let's say. Ben doesn't participate in any way in that trust. And that way, if there's a disclaimer, it's a clean break. There's also a regulation that says if I have a reversionary interest in a gift, it's an incomplete gift. And I don't think too many people are talking about that. It's a regulation under Section 2511. Happy to send you the citation if you've been thinking about that. So the disclaimer trust is a slippery slope and something that we need to be careful with. Another possibility is I could make a gift to a spouse of mine and leave open the option of either making or not making a Q-tip election with respect to that marital trust. I draft it exactly the same as any other marital trust, but I postpone the obligation to make the Q-tip election until my gift tax return is due, which is no earlier than April 15th of next year and can be extended to October 15th of next year. That leaves me in control, not some disclaimant. It leaves me in control of whether the gift qualifies or doesn't qualify for the marital deduction. And I can just sit quietly and watch to see what Congress does. And if they don't change the exclusion amount, that gift goes through. If they do change the exclusion amount, I make a partial Q-tip election for the amount of exclusion I can use. I don't make that election for the rest, and my spouse remains a beneficiary of the trust. The problem with a Q-tip trust is that it's leaky. All the income has to be distributed to the spouse. We can control that leakiness by either A, investing in assets that don't produce a lot of income, or B, perhaps instead of investing directly in income producing property, wrap up that income producing property in an LLC or another entity. The Principal and Income Acts of most states say that income, when you own an interest in an entity, is whatever the manager or the general partner or the president of the corporation decides it is. It's whatever they distribute. And if they don't distribute anything, there's no trust accounting income, and therefore there is no leakiness to the trust. Perhaps we could avail ourselves of that provision. I do like the Q-tipable trust a lot, and I think it has some usefulness. But perhaps the easiest thing to do is to structure most of the transaction initially as a loan or sale rather than as a gift. I create a grantor trust for the benefit of Ben. I put $11.7 million into that trust. Timing of that, we can negotiate off of this call. I won't spend any time talking about it at the moment, but we'll make a small seed gift to that trust, and the rest of it we'll treat as a loan or a sale at the short-term AFR. We wait until the end of the year to see what Congress does, if anything, with the gift tax laws. And if they don't change them, I take that note and I forgive it with the stroke of a pen. I've completed that gift and I'm not exposed to gift tax. 4 decent ways to avoid a retroactive reduction to the exclusion amount that should not result in the payment of any gift tax by our grantor / donor in this case. Let me pause there, much more to go, but let me pause there and see if anybody has any questions or comments about any of that. I was warned that this would be like being in front of the Supreme Court and I'd get interrupted frequently with questions. So please don't hold back. I think I've got one on the chat page. Let me look real quickly here.
You can ask questions both in the chat and through raising your hand, and we'll call on you.
Yeah, so one question came in, and it's based on Section 2505 of the Internal Revenue Code. And basically what that section says is this: if I make a gift, the credit that I get, not technically not the exclusion, but the credit that I get is based upon the credit that I would have gotten had I died on the last day of the year, on December 31st. And so if Congress, even if they didn't intend to make the statute retroactive, Section 2505 would make it retroactive because the credit is determined as of December 31st, not as the date of the gift. And that is true. I'm told that the Joint Committee on Taxation is aware of the fact that Section 2505 has this flaw in it, and that if there were to be a change to the amount of the exclusion, that they would also amend Section 2505, which signals to me that they have no intention of making such a retroactive reduction to the exclusion. Otherwise, they wouldn't care about Section 2505 and its application. that may be over inference on my part, but it appears to me that that's something that would get fixed if there were to be an issue. But as things stand right now, it's true that if I make a gift right now, I won't know for sure what my credit is. And therefore I won't know for sure what the exclusion amount is until I see what the law says on December 31st of this year. So we won't know for sure until the clock strikes 12 on New Year's Eve, and we see whether the law has actually changed at that time. By the way, does anybody remember ATRA that was passed in 2013? That was passed on January 2nd of 2013 and was made retroactive a whole day. Now, I don't know how many of you were working on New Year's Day of 2013. I wasn't. I can barely remember New Year's Day of 2013, but it is possible for Congress to pass something that sneaks into next year and make that retroactive. And certainly they can do that by 8 months, as happened in 93, or they can do that by a day, as happened in 2013. Okay, anything else? Any other questions from anybody on the call right now? Okay, got one coming into the chat room. Might as well deal with that now. What are your thoughts related to the accelerated funding of life insurance trusts to pay future premiums, given the proposals to lower the ability to gift trusts? I actually would like to address that. And I think what I'd like to do, Ben, is have you pull up the presentation because I've got a case on that. But as you're bringing that up, I'll just address the group. One of the quirks of my professional career is that I started out working in the law firm as an estate planning attorney, and I ended up, before coming to Bernstein 16 years ago, working as a partner in estate planning attorney practice. But in between, I was in a quirky little business called the private placement life insurance business at a carrier called Zurich Life. And the private placement life insurance business is designed to allow investors to invest their portfolios through a life insurance policy that's institutionally priced, that bears very, very low fees. And if you structure that properly, you follow certain rules, the investments inside that policy should not be subject to current taxation. And if that policy manifests itself in a death benefit of the insured, that death benefit should be paid in cash, income tax free, unless there's been a transfer for value under Section 101 of the Internal Revenue Code. So now, with tax rates looking like they're going to go up, the questioner is asking, doesn't it make sense to invest through life insurance policies rather than directly? And that can make sense as long as the costs associated with the life insurance policy are low relative to the taxes that the client otherwise would pay. In addition to that, back in December, something almost nobody noticed, Congress changed the statutory definition of life insurance to allow people to have a greater ratio of value inside their policy, the so-called cash value, relative to the death benefit of the policy. So for people who are, say, qualified purchasers that have huge amounts of investments, no less than $5 million, they could do a private placement life insurance policy that would have very, very low costs associated with it. People who don't have that much to invest could do this through a retail life insurance policy. And the thing that I would do if somebody gave me that, my job at Bernstein now is as an analyst. I just do math all day. I don't write documents anymore. I'll occasionally do some research, but most of what I do is mathematical analysis. So long as the implicit or explicit costs of that policy are relatively low as compared to the tax attributes of the assets, what taxes would be paid by that investor on those investments had they held them on their own balance sheet, life insurance could be a very, very valuable component of this. And in addition to that, and the reason why I addressed it now is because this is where I was going anyway, what about the proposal from your own Representative Cantrell or Senator Van Hollen in Maryland that would not only repeal the step up in basis, but also impose a deemed capital gain tax upon death? Those proposals differ in certain respects. The one thing that scared me about Senator Van Hollen's proposal is it would be made retroactive to the first of this year if it's enacted as law, although it doesn't seem to be getting any serious traction at the moment. But think about life insurance in that context. You take away the step up in basis. That's what the proposed legislation says, no more step up in basis. Well, if you have life insurance, the death benefit is in cash. You don't need a step up in basis. Life insurance is step up proof, I guess, or repeal proof in that regard. And what about the deemed capital gain tax at death? Not only do you lose the step up in basis, but we're going to impose, if this legislation becomes law, we're going to impose a capital gain tax. And on top of that, impose an estate tax and charge both of those taxes to the family. So how would that work? Let's assume that the family has $10 million of gain in the estate and let's say $20 million of assets. There is a $1 million exclusion in both of these bills. Let's ignore that for the moment. So somebody dies with $20 million of assets, $10 million of basis. What would happen under these bills? Well, first, there'd be $10 million of gain in the estate. Again, let's ignore the $1 million exclusion and assume that all of that gain is taxable. Let's assume that's in the state of New Jersey, and let's assume that the effective rate of tax on that gain is going to be 50%. So there would be a $5 million tax on $10 million of gain in the estate. Could be less than that if the rates stay where they are. Could be more than that if the rates are increased in the manner that President Biden has proposed. But there would be a $5 million capital gain tax to pay. That $5 million would be a deduction, not a credit, a deduction on the estate tax return. The taxable estate would go from 20 to $15 million. And then we'd still pay estate tax on the balance of the estate. So if the exclusion were $3.5 million, we'd have $11.5 million subject to tax. The administration has proposed a 45% estate tax rate. Let's assume that holds up. We're looking at a tax in the $5.5 million range on the estate. So $5 million of capital gain tax plus $5.5 million of estate tax on a $20 million estate. That's pretty punitive for an estate that's not that huge. The bigger you get, the harder you fall as these rules come down. Note that any assets held in life insurance would avoid all of that. If your client lives in Florida, creditors can't touch assets in a life insurance policy or an annuity. The same rule applies in Texas, and a couple of other places have favorable rules towards life insurance and annuities. So this is something that bears close watching by everybody in the audience today. How can we use life insurance not only to provide death benefit coverage in the event of an early death, but how can we use it to provide tax coverage, assuming that the insured lives a long time? And the key is to identify a policy that has substantial growth in it, but also has modest expenses associated with it. Each case needs to be evaluated on its own merits. Thank you for that question. Ben, I assume we're having a little bit of trouble pulling up.
No, I have them. I'm just waiting on the nod.
Okay, you won't get the nod because I covered what I wanted to cover. We could go back to it later, but we'll just skip that for now. I got another question in the queue, so I might as well jump right on that. Would charitable bequests, of specific property avoid the capital gain tax at death, charitable deduction for cap gains and the estate? The short answer to that, as I understand the proposals, is yes, that a charitable contribution would avoid both of those taxes. The only thing that I've seen that would affect the deductibility of a charitable contribution is on the income tax side. The president has proposed that the effect of any itemized deduction, including a charitable deduction, would be limited to the 28% bracket. So let's, again, follow that up with an example. Let's say somebody made a charitable gift during life, not at death. Let's say somebody made a charitable gift during life and they wanted to take an income tax charitable deduction on that. They made $1 million gift. If this proposal were adopted, the economic benefit of the deduction would be limited to 28% of that gift, $280,000. The balance of that gift, which would be $116,000, there would be no economic benefit for the deduction for that. That would be eaten by the taxpayer. I don't know that that proposal is going to get any traction whatsoever with the margins being so thin in Congress and Congress being so supportive of charitable contributions, it's hard for me to see, at least as things stand today, that that proposal would get any traction at all. But that would be one limitation on the income tax side. As for the deemed capital gain at death and for the estate tax, those would be excluded, as would any assets passing to a surviving spouse in a qualified form. Those would be excluded from both the deemed capital gain tax at death and from estate taxes. But the Van Hollen bill, and to a lesser extent, the Cantrell bill, would impose a deemed capital gain, not just at death, but every so often in the existence of a trust, every 21 years in the Van Hollen bill. And that would be true also of existing irrevocable trusts, that they would have assets taken away. All of these tax proposals bear a relationship to charity. Of course, people will want to avoid paying the tax. Is there a way that I can construct the estate plan that would take advantage of these charitable deductions and keep more of my money at work, rather than sending it off, most of it off to the government and having just a small fraction pass through to my descendants? One thing that I have always liked to use when I was in my attorney days, my drafting days, and even now I like to show it to clients, although it's a little bit hard to illustrate, is the so-called testamentary charitable lead annuity trust, the TCLAT. A very interesting strategy where if you have somebody, let's say it's a client, and let's say they're single, they really don't want to pay any estate tax whatsoever, and they feel they're taking care of all the people they care about using their exclusion amount, currently $11.7 million. All of the excess could go right to charity, and that could be a very, very useful thing. But an alternative would be to have any excess go to a zeroed out testamentary charitable lead annuity trust, where the trustee would be instructed to create the trust for a period of time, let's say 15 or 20 years, and make distributions to charity every year and structure those distributions so that the value of the distributions being made to charity on a present value basis, there'd be a present value computation, that the value of those distributions is exactly equal to the residue of the estate. So no estate tax would get paid on that amount. And that would give, at the end of that 15 or 20-year period, the non-charitable beneficiaries of the estate a second bite at the apple. They might get more if there's anything left in that charitable lead annuity trust at the end of its term. That's a very useful planning device. It's a way to sort of zero out the estate tax, even if the decedent is not married. The problem with it is that the structure is very dependent on what interest rates are at the time the decedent passes away. If those interest rates are low, there's a very good chance that that trust will have some assets in it for the non-charitable beneficiaries after 15 or 20 years, and those assets would go to those beneficiaries free of any additional gift or estate tax. But if interest rates are high at the time that the decedent passes away, the annuity payments to charity would be higher, and it may be more difficult to have any assets left in the trust available to beneficiaries. That could be an interesting strategy that those of you who are on the plan giving side could talk to clients about and say, hey, not only do we have an estate tax, but we have this looming potential deemed recognition of gain at death. And this kind of a charitable strategy might avoid both of those outcomes potentially. Time will tell whether it avoids the deemed realization of gain, but we may have a situation that would avoid some tax at death. As things stand right now, a gift of appreciated assets to a charitable lead annuity trust, it's not clear whether that would qualify for the income tax charitable deduction under the statute. I don't recall seeing anything in Senator Van Hollen's bill, although I've got it right here and I could read it to you. I don't recall seeing anything in Senator Van Hollen's bill that addressed a charitable lead annuity trust. Let me pause there and see if anybody has any questions about anything. So far, so good? Okay. By my clock, I still have at least 8 minutes left, so that's good because there are a whole host of other things that I'd like to talk about. And again, one of the things that I think is a real threat, if this should ever get any traction at all, and that is in Senator Sanders' bill, and these were things that were discussed during the Obama administration, would be the elimination of grantor trusts and the elimination of the GRAT, essentially the elimination of the grantor retained annuity trust. One of the great things about being in a low interest rate environment, and we're still there, is the ability to give assets to a grad or sell assets to an intentionally defective grantor trust, have those assets inside the trust grow unfettered, have the trust owe me, the creator or seller of the assets, owe me whatever I put into that trust, plus a tiny bit of interest, and all of the growth above that interest rate ends up in the trust and out of the estate tax system. That's an extraordinarily powerful strategy. And Senator Sanders' bill would take the teeth out of grantor trusts and take the teeth and claws and basically all the limbs out of grats and make those essentially worthless as a planning strategy. No indication that they would go after any of our favorite charitable strategies, the charitable remainder trust or the charitable lead trust, but they would go after those things. So much in estate planning, especially over the last 20 years, has been based not just on the ability to give money to a trust, but the ability to retain the obligation to pay income taxes with respect to that trust. Think of charitable donors who do income tax planning. We know that their ability to contribute to charity is based upon a percentage of their adjusted gross income. If they make a big gift to a taxable trust and the assets that they put in that trust are generating a lot of taxable income, the trust and the beneficiaries are bearing that tax now. That's not adjusted gross income of the grantor anymore, and their percentage limitation has now been reduced because their charitable base is reduced, their AGI has been reduced. When a client creates a grantor trust, that percentage limitation doesn't change because they still are responsible for all the income tax that the assets in that trust generates. So for those people who are very generous with charity and also very generous with family, using a grantor trust can be a very powerful combination because AGI is not affected when you put assets into the trust. The full percentage limitations are still there, and the clients can continue to do the kind of giving that they otherwise would do with charity. What do you do when you don't know what the capital gain tax rate is? That's kind of where we are right now. We don't know, for many of our best donors and our best clients, we don't know what the capital gain tax rate is. The president announced that he was going to increase that rate and was going to make it retroactive to April 2028. And so I've had a couple people, business owners, within the last few weeks say to me, if the capital gain tax rate is still 20%, I'll sell my business this year. But if it's not, if it's almost double that, I'm not doing it. And what do you say to somebody like that? You say, well, I just don't know what the rate is. I don't know what the rate's going to be. We'll just have to wait and see what Congress does with the law. I don't like that response. I think that's wimping out. So what I would do is say, what can a business owner do to try to protect themselves in the event that the tax rate has already gone up, that it's already 39.6%, or maybe it won't get to that level, but it's some significant amount greater than the current level of 20%. And a fantastic strategy for anything other than S corporation stock is a charitable remainder trust. A charitable remainder trust. I'm a business owner. Let's say I own stock in a C corporation, and there's somebody out there that wants to buy my company. And I'm considering offers right now. They want to buy my stock. But I don't know whether my tax rate on that sale, I've got zero basis effectively in the stock, and it's a $20 million transaction. I don't know if my tax bill is going to be 20% of that, $4 million, or nearly 40% of that, $8 million, assuming no state taxes associated with that, pile state taxes on top of that. What do I do about that $4 million gap? Well, what if far enough in advance of the transaction, I contribute some percentage of my shares to a charitable remainder trust? Now, when the purchase gets done, yes, I'm being bought out from my retained shares, but the rest of the shares are being acquired from the trust itself. The trust recognizes but doesn't realize that gain. It just gets entered into the books of the CRT, and the gain gets distributed out to me over my lifetime as a percentage of the assets if it's a CRUD, but it gets spread out over my lifetime. So I don't have to pay that piece of the tax. And what I found in illustrating that for business owners is that got them off the fence. They said, okay, if the tax rate has gone up and I put enough of this in a CRT before the transaction, then I should be, I will be able to pay that tax because much of it will be spread out over my lifetime rather than all paid in 2021. That's a very, very useful strategy that I think you would like to see. That would be something that I've spent a fair amount of time on this year, helping guide clients through that potential process. Again, that does not work with S corporation stock, but it could potentially work with a limited liability company, and it definitely could work with a C corporation. The same would be true with real estate.
Tom, you froze for a second, so let's see if you come back.
While Tom is regrouping, this is a great time to also add in any last minute questions because it's almost 1 p.m. and we know that everybody needs to get back to work. And here's Tom.
I warned our sponsors that I probably would disappear for 45 seconds, and I chose the worst possible moment. But think of that CRT for the business owner or real estate owner as a way to mitigate that. I did have one question come in just as I was going through that. Let's try to get that right now. Is a sale to an IDGIT a potential technique to avoid deemed realization under the president's proposal, i.e. the note and not the assets are in the estate at death? Or do you expect this to be addressed in the final bill? That's a really good question. I don't know that there's a clear answer to that. There's, again, nothing in Senator Van Hollen's bill that I saw that would have addressed that specifically. Of course, there's lots of arguments about whether that's income in respect of a decedent. I don't believe that the note is income in respect of a decedent. I've heard other people say that. It's not, but it's too early to tell whether that would be the note that remains in the estate would be subject to the deemed capital gain tax at death. I think I'm at just about at the point where I'm concluded, but anybody have a last moment question here? We covered a lot of ground and I appreciate your patience and indulgence getting through all this material. Anything that we didn't get to that you're interested in? Well, if you change your mind about that, please send to Ben or Yafa your email. They'll forward it to me and we'll get your answer back to you in writing. Thanks to the Federation for inviting me to participate and for Ben for helping me out getting organized to do this. And I'll turn this back over to our sponsors here, to Jenny.
Tom, thanks very much for joining us. Just for those who are on, please stay on. We're going to do a brief survey, which helps everybody on the call get their credits. So please make sure you fill out the survey. I'll just reiterate, right? Tom said he does a lot of math all day long. To the extent that you have a client circumstance that you are, wanting to see how it would play out, you probably noticed from the presentation we sent around that there are a lot of summary pages that do try to articulate, choosing path 1 versus path 2. And if that's ever helpful for you, please let us know. The survey is up and I will kick it back to Yafa in case there's any parting shots or future events we should be aware of.
Thank you so much for joining us today. Thank you, Tom. Thank you, Ben, for bringing us to Tom, and Jenny and the rest of the committee for helping plan today's event. If you have any suggestions on topics that you would be interested to learn more about, please let us know. If not, we will be gearing up for more events this fall after the summer, and we're hoping to have at least one in person. So that would be really nice to see you face to face. Please feel free to stay on and unmute yourselves now. And if you have any last minute questions, Tom is still on, so let him know.